Hello everyone, I hope you guys are doing well and studies going in full swing. Now in today's video, we are going to discuss for your CA Final FR, RTP of November 24, MTP Series 1 of November 24 as well as MTP Series 2 of November 24, all the MCQ case-based questions as well as all the different questions and different adjustments that merit your attention and review. So there are quite a few repetitive questions which you would have covered in the course of your preparation. We are keeping that aside. So in case you have limited time, just cover this video up, and even if you don't have that time, I would recommend that you at least go through these questions from your RTPs as well as the MTPs, so to kind of have that closure of your logical loop. So we'll just quickly go through these questions first. So we are in the RTP of November 24. So this is case study scenario 1. The first paragraph is a general paragraph for a company for 20x17. Now 3 MCQs, 1, 2 and 3 from this, and this pertains to Ind AS 115, similar to the study material concepts only. On 1st October 16, D sold a product to customer for 1,21,000. The amount is payable on 31st December 18. So that's around 2 years, 3 months later. The manufacturing cost of the product was 80,000 and the customer had a right to return the product for a full refund at any time up to 31st December 2016. So let us say that is 3 months, a right to return. The next sentence is important. At 1st October, D had no reliable evidence regarding the likelihood of return of the product for the customer, and as a result, as per 115, you can recognize revenue at an amount that an entity expects to be receiving. Now, because you are not very sure about whether the customer will return the products or not, you cannot recognize revenue on 1st October. Instead, you can recognize it on 31st December when the return period expires or the customer does an action before that which communicates his acceptance. So the product was not returned before 31st December and hence you can recognize revenue. So the right of return for the customer expired. So you can book a revenue. Now ideally you can book a revenue at the transaction price. However, there is a significant financing component because the time gap between the date when the goods are delivered and the consideration received is more than 12 months. On both 1st October and 31st December, the cash selling price of the product is 1 lakh. And a relevant rate to use for discounting calculations is 10%. So basically over here, as per 115, you will recognize revenue at the cash price equivalent, that is 1 lakh rupees on 31st December, not on 1st October. You might have done a sum earlier, maybe where there is 1st October. If we thought that the return is unlikely to happen, then you can recognize, but here there is no reliable evidence that can tell you that the return will or will not happen. So we will wait till 31st December and then book the revenue. Okay, how much is the revenue, sir? 1 lakh rupees, and then slowly recognize interest income. So if I look at these MCQs over here, when and by what amount the revenue will be recognized for sales made on 1st October, when the answer should be 31st December, and what amount the answer should be 1 lakh. So if I go to see, this is 1 lakh and this is 31st December. Okay, so this is point 1. Second, what will be the amount of finance income to be recognized with respect to sales? Only for the year 6-7. Remember, finance income will start once the revenue and the debtors are recorded, that is 31st December. And for the year 6-7, there would be, let us say, only 3 months. And hence 1 lakh into, I think the relevant rate to be used was given to you as 10%, but this is only for 3 months. And hence this will come to possibly 2,500 and hence your option B. Third, what will be the amount of trade receivables on 31st March 17 against the sales made? So this is 1 lakh rupees which were initially there plus 2,500 of finance income. Slowly we will keep on increasing this over the 2-year period to reach up to 1,21,000, but till 31st March 17 will be at 1,02,500. That is your option C. So this, you just need to be careful of 2 areas. First, sales are not recorded on 1st October but on 31st December at the cash price, and then interest etc. will be recorded only for the next 3 months. Second, on 1st July, we began an arrangement to sell goods to a third party. The price of the goods was 100 per unit for all the sales during the 2-year period. However, if the sales of the product exceeded 60,000 units in the 2-year period, then the selling price would be reset retrospectively to 90. So there is a price adjustment, 10 rupees. There is a difference between 90 and 100 is variable. Sales of the products to be in the 9-month ended 31st March 2006. This is from, let's say, 1st July to 31st March is 20,000. And at this volume, it was not expected to change till 30th June 17. So basically that means if for 9 months you have managed to sell 20,000, then for 24 months you will manage to sell how much? So this is 20,000, let's say, divided by 9 into 24 comes to around 53,000 units, which means you're not crossing 60,000 units, and hence your revenue will be at 100. So if I look at MCQ number 4, they say what will be the amount of revenue to be recognized for the year 5-6. So for the year 5-6, we believe that the consideration will be 100 per unit and you have sold 20,000 units and hence the revenue will be 20 lakhs. However, in the year ended March 17, that is the next year, total sales were 35,000 based on the current orders from B. So this is for the year, okay, not till date, this is for the year, 35,000, and the estimate was revised. Directors of D now estimate the total sales to be in the 2-year period up to 30th June would actually cross 60,000. So now what will be the revenue? Well, we will say that now the transaction price will be 90. We don't think it will be 100. So 90 into, well, till date, you have sold 20,000 plus 35,000. And hence, till date, your revenue to be recognized will be 90 into 55,000 comes to around 49.5 lakhs, out of which 20 lakhs was earlier recorded, and hence I believe 29.5 lakhs will be the revenue that is to be recorded for the second year. You cannot go back and retrospectively change the revenue of the last year because this is a change in accounting estimate, not a change in policy. So that is your first case scenario. Second case scenario, this is a little interesting when it comes to Ind AS 19 as well as Ind AS 16 as well as 37. So first part is Ind AS 19, again a very general discussion at the beginning. Then point 1, A has established a defined benefit pension plan for its eligible employees. The balance sheet of A on 31st March 17 currently includes estimated net liability, emphasis on the word net. So this is asset minus liability or liability minus asset, the net liability that is appearing in the balance sheet. Directly the net amount is given at 31st March 16 amounted to 18.75 crores. Now I don't have the breakup between how much was the plan assets and how much was the total liability. I just know the net amount, and that is the amount that you show in the balance sheet. The following matters relating to the plan for the year ended 31st March 17. So this is during the year. The estimated current service cost advised by the actuary was 6 crores. So this will increase the plan liability, and there will also be a corresponding expense in the P&L. On 31st March 17, A paid contribution of 7 crores to the plan. Ideally, this should increase the plan assets. I don't have the plan assets separately. However, I have the plan liability minus plan assets, that is a net amount. So what happens is, if there is a 7 crore increase over here in the plan assets, that will in a way reduce my net liability, because my plan assets increase, then my net liability will fall. So this is a point where you might face some resistance. And charge this amount as operating expense. Now this is out and out wrong. Remember, if it's a defined benefit plan, contribution increases the plan assets. It does not go as an expense in the P&L account, so that is wrong. The annual market yield on high quality corporate bonds on 1st April was 8%. So this will be the return that is used for the purpose of expected return on plan assets, as well as the interest on the plan liability. On the net amount, you will apply 8%. Also, contributions are made at the end of the year, and hence there will be no interest impact on those contributions. The estimated net liability, again the word net liability, on 31st March 17 was advised by the actuary to be 20.5 crores, which means so if there is some difference, the difference will be actually taken against the actuarial gain or loss. No benefits have been paid till date. Okay, so that is sub point 1, against which you have MCQ number 6 and 7. So let us review MCQ number 6. What is the amount of net adjustment to be made in the statement of the profit and loss for the year 6-7 in respect of the defined benefit pension plan? So this is in the P&L. What will go in the P&L, sir? Current service cost of 6 crores ideally should go to the P&L. Interest on the net liability of 18.75 into, I believe 8% is the rate, so 18.75 into 8% comes to around 1.5, and hence this 1.5 should also go to the P&L account. So this is 7.5 going in the profit and loss account. Instead, what have you recorded? You have recorded a contribution of 7 in the P&L, and hence if an adjustment has to be done, 7 is already recorded. It is wrong, but it is already recorded in the P&L. Ideally 7.5 should be recorded, and hence a net adjustment of 0.5 should be made in the P&L. So 0.5 should be deducted from the profits. Your answer should be option C. Then you go to 0.7. What will be the amount of actual gain or loss on the defined benefit plan for the year 6-7? Now what happens is, there is some liability, there is some asset, and that will give you the net liability. Now the net is 18.75. Now over here what happens is, the liabilities during the year are increasing by 6. So that will definitely increase your liability. Apart from that, remember, interest at the rate of, if I am not wrong, 8%, which is 1.5, will increase because it's a net liability. This will increase my net liability. And then comes assets. Now assets are going to increase by 7, but that is going to be deducted when I calculate the net liability. So basically liability minus assets will give you the net amount, and hence this is going to be minus 7. So if I go to see my closing liability should ideally be 18.75 plus 1.5 plus 6 minus 7, and hence ideally my liability should be 19.25. However, my liability appears to be 20.5 as per the actuary, and hence there is an increase of around 1.25, and this will be your actuarial loss. Your liability is increasing and hence there is an actuarial loss. The only thing that you can possibly be attentive over here is the contribution. Ideally it should increase the plan assets, but when I do the net liability, plan liability minus plan assets, so an increase in plan assets that will be reduced while calculating my net liability, and thereby I will come to around 1.25 of actuarial loss, which comes to around 1.25. Okay, next you go to point number 2. On 1st April 20, let's say XXX0, E completed construction of a non-current asset with estimated life of 20 years. The cost of construction were recognized in PP, that is correct, and depreciated appropriately, that is also correct. He has a legal obligation to restore the site on which the non-current asset is located by 31st March 20x0, that is after 20 years. The estimated cost of this restoration work at 20x0 prices is 2.5 crores. So we will have to create a present value pay provision for site restoration. So 2.5 at present value for a period of 20 years. The directors have made a provision at 0.125. This is 1 by 20 of 2.5. This is out and out wrong. It is not that you have to spread it on a straight line basis over 20 years. No, you have to record it on a present value basis and then unwind it. In the draft balance sheet of 31st March 20x1, in the appropriate discount rate is 6% and the present value is 0.31. So basically on 1st April 20xx0 or 2xx0, this will be 2.5 into 0.312. This will come to 0.78. So you will create a provision at 0.78. You will credit the provision and debit the PP, and thereby this will be recorded as let us say 0.78 rupees. So over here you will have PP increasing by 0.78 and corresponding to that even a provision, let us say, increasing by 0.78. So over here this will be having some other spillover effects. If PP is increasing, there will be depreciation 0.78 over 20 years, and hence the depreciation of 0.039 should ideally be recorded. And if it's a provision pay unwinding will happen at the rate of 6%. So this is 0.78, just a second, 2.5 into 0.312, yes, 0.78 into 6% comes to 0.0468. So basically in your profit and loss you should record 0.039 for depreciation, because your PP will increase by 0.78, as well as 0.0468 as unwinding cost. So if I total both of these, it possibly is an expense of 0.0858 that should be recorded in the P&L. However, what you have currently recorded is 0.125, and hence some adjustment may be required. Let us see what the question is asking us. What is the original provision required to be made on account of the restoration of original provision is 0.78, option A. Second, what will be the amount of adjustment to be made in the retained earnings on account of restoration? So we are saying to the retained earnings, we have already recorded a cost of 0.125, which needs to be reversed. Instead, 0.0858 has to be recorded. So if I go to see, maybe this is 0.0392, an adjustment of 0.0392. If I see, yes, option C should be taken. What will be the amount of 1 year's unwinding? This is 0.0468, I believe we have calculated, that is point A. And that takes care of your MCQs which are there in your RTP of November 24. Among the MTPs and RTPs, I would say even there is something to look at in the RTP MCQ. MTP MCQs are fairly easy, bearing 1 or 2 MCQs that you will study, but otherwise by and large it is manageable. Now on the descriptive side, there are 3 questions to be referred. 11, which is on Ind AS 12. Now in this question they are talking about tax base. What is tax base? Quite literally, that is loosely speaking the amount appearing in the tax balance sheet for which ideally if it's an asset I will get a deduction. So the amount of deduction I will get is usually taken to be the tax base of the asset. Now sometimes what might happen is an asset might be utilized in a particular way. Like for example, if I have a PP, If I intend to use the PP over the future years, I will get a depreciation, and depreciation is deducted under PGBP, which may be at 30% rate. However, if I intend to sell the asset, then the asset will be allowed as a deduction while calculating capital gains, cost of acquisition, in which case my tax rate will be, let's say, 20%. So I will apply different tax rates depending on the management's intention to utilize the asset if there are different possibilities available. Similarly, there is a possibility that the question might ask you to calculate tax base. The tax base is the amount that you intend to claim as a deduction while calculating your income tax workings. Now over here, that again depends on how you intend to utilize the asset. Based on that understanding, the institute has formulated a question largely on tax base calculation. So let us review this. It's a different concept over here. X Limited is an Indian company, owns a freehold land with a carrying value of 10 lakh rupees. So basically this is a value as per Ind AS 16 and this is 10 lakhs, which is not depreciated for tax purposes, but it is indexed for inflation. Okay, so like this is your indexation that happens in capital gains, which is again in budget there are some changes here and there, but let us say indexation is there. Indexed value and fair value of the land is 15 lakhs and 22 lakhs. Fair value is not looked at in income tax at all. Indexed value is probably the indexed cost of acquisition as of the reporting date. Then what will be the tax base for such a freehold land for the measurement of deferred tax? The question is not asking you to calculate deferred tax, it is largely asking you to calculate the tax base. So let us review this. Point 1, X intends to sell this freehold land as a part of a slum sale, that is a sale of the entire division, for example, of business, eventually after using it for business purpose. That is the first thing. Second, it intends to sell the land individually and not on a slum sale basis. Third, X has classified such land as investment property and intends to sell it individually and again not on a sum sale basis. So point 2 and 3, you are intending to sell it individually. In point 2, maybe you are using it for your own business and then selling it. Maybe in books it is PP. In point 3, you are using it as an investment property and then selling it. In your books it is investment property, but basically you are looking up at income tax. X follows a revaluation model of freehold land and intends to sell it individually and not on a slum sale. Again, so in each of these cases, you want point 2, 3 and 4, you want to sell it individually. In point 1, you want to sell it as a part of slum sale. Now again, you are solving an FR paper, not the tax paper. So institute will give you some guidance. As per the applicable tax laws in the jurisdiction, indexation benefit is not available if the freehold land is sold as a part of a slum sale. If you have done, let us say, if you are giving both groups and you have done DT, you might be aware of this, but nevertheless institute believes that even if you are giving one group, we will tell you that, let us say, you will not get the index cost of acquisition at the time of slum sale, but indexation benefit is available if freehold property is sold individually. So in each of these three cases, point 2, 3 and 4, you will get, let us say, indexation benefit. So carrying value, let us say, the question is not asking you, but let us say if I had to solve, what is the carrying value, what is the tax base? Well, carrying value in general, even if it is not asked, in the first subpart, carrying value is the value as per Ind AS, which is 10 lakhs. What is the tax base? Well, tax base over here would be the deduction that can be claimed because of this freehold land in income tax records. Now, for income tax records, you are not going to get the index cost of acquisition. In case this is sold as a slum sale, you will get whatever is your cost of acquisition, which is 10 lakhs, and hence there is no difference. If there is no difference, there is no deferred tax consequence as well, though deferred tax is not asked. In the second part, you want to sell it individually and not as a slum sale basis. In your ledger, in your Ind AS, it is still 10 lakhs. However, as per income tax, your value comes to 15 lakhs because now you will get the index cost of acquisition as it is clearly given over here. You will get the indexation benefits. And as a result, when we look at, let us say, your tax base, you will get a deduction of 15 lakhs, which means you are getting a high deduction, let us say, when the sale happens, and hence you will pay a lesser tax. So over here, this is, let's say, a 5 difference, which will create, let us say, a DTA. You will get a more deduction in the future years when the sale happens, so that's the DTA point. So generally for asset, when the tax base is greater than the carrying value, your answer is in the same direction. So it's an asset which will create a deferred tax asset. In case it is asked, it is not asked over here. Again, even if the land is held as an investment property and you intend to sell it individually, this will still be the same 10, 15. There is a difference of 5 rupees, which will give more deduction under income tax in the future years and thereby create what we call as a DTA. The last case, you follow a revaluation model, in which case in your books of accounts, the land will now be shown at 22. Income tax will still give you a 15 rupees deduction and hence there is a difference of 7. But this difference of 7, carrying value is greater than the tax base, so your answer is opposite and hence this will create a deferred tax liability. Income tax will give you only 15 ka deduction, whereas the books mein 22 ka milega, and hence the 7 lesser will create a liability and this will be created as a DTL. Second effect will generally go against the OCI as a revaluation surplus because this is created as a part of your DT as a part of your revaluation adjustments. So question is asking you just these parts. So if you just do this, it is more than sufficient. Institute has given you a very detailed solution. You can just remember these items. So whatever am I going to get as deduction in income tax, what is appearing in my tax balance sheet, for example, is my base for the purpose of income tax, which is 10 for slum sale, 15 for everything else. Okay, so this is 11. 12 is a case on lease, which is similar to questions which we have done in the institute materials. Even the question of agriculture, all of these are similar, so we are not really going to that again. Ind AS 36. There is a question number 15 which is slightly different. This is on the impact of restructuring. Now the concept, as you would be aware, that under Ind AS 36 we need to calculate value in use, and value in use is calculated as a present value of future cash flows. Now these future cash flows you can predict, and while doing so, Institute has given you some guidance. One of the guidance is that in case there is a restructuring will possibly create certain benefits. And hence, Ind AS 36 says that sometimes what might happen is, in order to kind of manipulate your value in use, you might actually say that in the future I will do a restructuring because of which I will get this benefit. Like I have, for example, a car, and we are talking about 2010. We have a car, and let us say I have a problem with drivers. A lot of them are leaving, not operating well. I say that I will get a software in the future which will probably put a technology or do some restructuring whereby I will eliminate the need of a driver. Have you actually implemented that? Well, not yet. And hence Ind AS 36 says that till the time you actually implement or are committed to the restructuring, you are not going to take the benefits of the restructuring. Yes, you will not even take the cost of the restructuring, both sides. The cost that is there for the restructuring you will not take, but the benefits that you will get on restructuring, that also will not be taken. Till when will it not be taken? Till the time you are committed to the restructuring. Now, restructuring ke liye there is a provision that you create as per Ind AS 37, provisions and contingencies, which says that if there is a legal obligation to restructure, like a court order which requires you to close a division, or a constructive obligation which arises either when there is a formal plan in place and there is a constructive obligation, that is, the plan is communicated or it is started implementing, that is when you create a provision for restructuring. That is the point when we say that you are committed to the restructuring. Once you are committed to the restructuring, you can consider the potential expenses for the restructuring. You can also consider the potential gains of the restructuring. But till the time you are committed to the restructuring, you will not consider any of them. That is two things that you should know. And the third thing over here is, if you remember, when you discuss provision for site restoration, let us say there was a property, plant and equipment which was appearing in your books at 110. There was a site restoration provision obligation appearing at 10. And let us say over here, there is a buyer who is quoting you fair value as cost to sell of 105. So the question is, this 105, let us say it is a recoverable value. You will compare it with what? Will you compare it with 110 directly? No, the buyer is paying you for both asset and liability, and as a result, 110 minus 10, that is equal to 90 for something. Sorry, 110 minus 10, that is equal to 100. That 100 will be compared with, let us say, 105, and you are saying that for net assets, net of the provision, in your ledger is 100, buyer is paying you 105, there is no impairment. Similarly, over here, any kind of provision which is there attributable to this asset, you will record the net carrying value and compare it with the recoverable value. So these are the three things you have to remember. First, in case there is restructuring, you will not take the benefits or cost of restructuring till the time you are committed. However, if you are committed, you will have to take the cost as well as the benefits. Second, when do you create a provision for restructuring as per Ind AS 37? When you are committed, that is, there is a legal or a constructive obligation. And third, when you calculate the impairment, you will compare the net carrying value of the asset minus the liability and compare that with the recoverable value to determine the impairment. Okay, so let us review question number 15. At 31st March 20x1, the assets of the CGU are being reviewed for impairment. The carrying amount of the CGU's net assets is 65 lakhs, excluding restructuring provision. So over here, this is purely the value of the assets, and the remaining useful life is 8 years. Management's approved budgets at 31st March 20X1 include restructuring cost of 3,50,000. So management has approved the budgets, but merely because it is there in the budget does not mean you are committed to restructuring. Like you might budget various things in your life, that does not mean those things have to actually happen. So management's approved budgets as on 31st March 20X1 include restructuring cost of 3,50,000 to be incurred in 20X2. The restructuring is expected to generate cost savings of 1 lakh per annum from 20X3 onwards. So from the next year onwards, there will be a 1 lakh savings. Formal budgets have been prepared for 3 years to 31st March 20X4, and a zero growth rate is assumed because market is extremely competitive and this is expected in the foreseeable future. That is fine. The future cash flow estimates are, so you have this big table starting from 20X1 to all the way up to 8 and 9 with restructuring and without restructuring. In 20X2, the net cash flows without restructuring are 8,70,000. Okay, there you are. Exceed the net cash flows with restructuring 5,20,000. Okay, so with restructuring the cash flows are lower by an amount of restructuring cost, that is 3,50,000. So we believe that we'll spend 3,50,000 and hence the cash flows in the next year are lower if restructuring is going to happen. So 8,70,000 minus 3,50,000 will come to 5,20,000. We have been told that the benefits of restructuring are 1 lakh per annum from 20X3 onwards, and hence if there was no restructuring we will earn 9 lakhs. 9,50,000 with restructuring will earn 1 lakh more. So even if this column was not given, see here they have spoon fed you, but my point is even if this column was not given, you could have still derived it. Like you would have said 8,70,000 if I am going to get without the restructuring, and if in 20X2 there is going to be restructuring cost of 3,50,000, I will get 5,20,000. Once restructuring is done, benefits come from 20X3 onwards. Instead of 9 lakhs I'll get 10, instead of 9,50,000 I'll get 10,50,000 and so on. Okay, so we can find this. Now, should you take restructuring into your calculations of value in use or not? Well, it depends on whether you are committed to the restructuring or not as of now. So, the future cash flows excluding inflation have been discounted at the rate of 4%. For simplicity, it has been assumed that the cash flows arise at the end of each year. Compute impairment loss on 31st March 20X1 when the restructuring costs are recognized in the financial statements at 31st March 20X1. Let us say there has been a constructive or legal obligation, maybe you have done public announcement, etc., and hence you have created a provision for restructuring already at 3,50,000. You have not yet spent it. Value in use is based on the present value of future cash flows, but you have not yet spent it. However, a provision is created. And second, restructuring is not recognized in the financial statements as on 31st March 20X1. So if it is not recognized, that means you are not yet committed to the restructuring, and if you are not yet committed to the restructuring plan, then the standard says that you will ignore the benefits of restructuring and directly to discounting factor at the rate of 4% over here for each of these years and find, let us say, the value in use. Similarly, if you are committed to restructuring, so this is your answer to subpoint A, this is your answer to subpoint B, at least for value in use calculation. The question has not given you details regarding fair value as cost to sell. So value in use will be taken as the recoverable value. In the second subpart, you are not committed to the restructuring, no provision is created, and hence your value in use is based on the present value of the cash flows from 8,70,000 to 9,50,000, which is discounted at the rate of 4%. If I just borrow this for the benefit of time, if we skip this 62.73 and 65.14, if you want you can pause and try to do the calculations. 62.73 and I think this was 65.14. This is your recoverable value. But with what will you compare? Well, I will compare the carrying value with the recoverable value. The recoverable value in the first instant is 65.14, in the second instant is 62.73. Now I will compare this with what? With the amount that is there in your ledger. Your carrying value of your assets are 65 lakhs, but in the first case there is also provision for restructuring. So when I look at present value, this is 5,20,000, this is after deducting 3,50,000 of restructuring cost. So over here in my ledger as well, when I will take, dekho, 65 is there, but there's 3.5, apple to apple. I will say that when I calculate 65.14, I've deducted 3.5. So if that money is not yet spent and that provision is still appearing in the balance sheet, I will also deduct that 3.5 over here. Like in amalgamation or business combination, you compare PC with the net assets, not with the total assets, because when you are taking over the assets as well as the liability. It is like saying that if a buyer takes over the company as of now, the buyer will get the benefit of the asset, but that buyer will also have to incur 3,50,000 of restructuring, and hence if I'm committed to the restructuring, the buyer will have to pay even for the restructuring. So 65.14 is against the asset and liability both. So comparative to 65 minus, let's say 3.5 comes to probably 61.5, and hence there would be no impairment in the first case. Why? Because your carrying value is lower than the recoverable value. There is no impairment if restructuring is committed. But if restructuring is not committed, your carrying value continues to be 65. There is zero provision in your books, and hence 65 minus, if I am not wrong, 62.73 comes to a 2.27 impairment loss. Let us just verify this once. This comes to 62.73 so 65 minus 62.73, 2.27. So over here this is 2.27 impairment. In the first case there would be no impairment of the CGU. So I hope this is clear. Then the other questions are similar. Even question number 20 which is there, I would say it is broadly similar, but there are similar questions. I think there is a question in your study material regarding land which was divided into three parts. One part is used by one partner, one part is used by another partner, and the third part is going to be commonly used. So what is a joint operation, joint venture over here? Now you will read the question over here. The question is asking you something. I believe that there is some error which may need to be kind of looked at, but let us try to review question number 20 over here. Now P Limited and Q Limited entered into a contractual arrangement. They just tell you contractual arrangement, nothing more. What is that arrangement? For example, to buy a building that has 12 floors, they will lease, which they will lease to another parties. P and Q are authorized to lease 5 floors each. P and Q can unilaterally take decisions relating to their respective 5 floors and are entitled to all of the income from those 5 floors. So for the first 5 floors, they will be fully along with P only. There is no joint operation over here. For the next 5 floors, they will be fully with Q only. There is no joint operation or joint venture. Total 12 floors, so there are 2 floors remaining. The remaining 2 floors will be jointly managed. That is, all decisions regarding these 2 floors must be unanimously agreed between P and Q, who share net profits or losses in respect of these 2 floors equally. So here there is joint control. For the 2 floors, we can clearly say that there is a joint control. That is, they both have rights to the net assets of the arrangement. Okay. The leasing of the property is determined to be relevant activity. So that is an important activity, whether this arrangement is a joint operation or a joint venture. So when I look at this overall operation for the first 5 floors and next 5 floors, there is no joint control. So there is no question of a joint operation or a joint venture. The question only arises for the last 5 floors, last 2 floors. Now the problem in my understanding is, when do you say that there is, let us say, a joint venture? A very clear rule for the existence of a joint venture is there has to be a separate legal entity in the middle. The legal entity can be a firm, it can, an LLP, a trust, it can be a company, it can be anything, but there has to be a separate entity in the middle through which you are doing the arrangement, in which case it can be a joint venture. There are some exceptions to that as well, but the existence of a separate entity, in my understanding, is non-negotiable. There has to be a separate entity in the middle to call it as a joint venture. And if there's no entity in the middle, it will always be a joint operation. So over here, from what we see over here, there does not appear to be a separate entity for the last 2 floors. It is just a contractual arrangement. That is a piece of paper they have signed. Chalo, we will construct 12 floors together. That is just about it. So if there is no separate entity in the middle, ideally the answer should be a joint operation. So if I had to solve it without seeing the suggested answer over here, I would say that this is a joint operation. However, Institute has mentioned that this is a joint venture. See, there's a joint control for the last 2 floors. No one is debating that. There's a joint arrangement, yes. But for there to be a joint venture, there has to be a separate entity in the middle. I don't see a separate entity over here. So maybe if you want to write and keep it consistent with the Institute solution, you can always say that assuming that there's a separate entity in the middle through which this arrangement is entered into, it is a joint venture. Again, that is debatable, because ideally, if you see this solution for the first for 5 floors, you will say this will go with Q. For the first 5 floors, you can say that this will go with P, and then comes the last 2 floors. When you go to the last 2 floors, they mention that this is a joint venture. Ideally, I believe there will be a correction over here where this will be a joint operation. But if the same thing comes, and knowing the history of how the Institute fares, if a same thing comes, you might as well put this as a joint venture, assuming that there's a separate entity in the middle. Okay, so over here, arrangement for these 2 floors is a joint venture. Ideally, it should be a joint operation if there is no separate entity. If there is a separate entity, then there can be a joint venture case. So that takes care of the RTP November 24 discussion. We will then go to the MTP series number 1. So when you look at MTP series number 1, I will have the MCQs, and I think there is a question 5B or something which is on lease, which is an interesting question. So these are the two things that you will focus on. Other things you would have by and large covered. So the MCQs over here are almost all based on the study material related questions. We'll quickly review them. So again, this is a generic paragraph. The first two MCQs for Ind AS 113, fair value measurement. So A owns 250 ordinary shares in an unquoted company which has a total share capital of 5,000. So I have 5% shares with a nominal value of rupees 10. The after tax mental profits are 70,000 per year, and the appropriate PE ratio from the industry data is 15 before the lack of marketability adjustment, because you are an unquoted company, so there will be some illiquidity. Is management estimates that the discount for the lack of marketability of X's shares is 20%, and A values its holding in X based on its earnings. So this is similar to earlier RTP questions which had come. So let's quickly review. So this is 70,000, which is the profits into, if I multiply the PE multiple of, so this is 70,000 into 15 comes to around 10.5 lakhs. Now this is the total value. There's a 20% lack of marketability discount, so minus 20% of the value of the entire company X Limited as a whole would be 8,40,000. 8,40,000 will be the value of X Limited as a whole. I'm holding 5% stake in that, so my value will be into 5%, that is 42,000. Now they've given over here the value of X Limited. Ideally it should not be a value of a share, value of X Limited. If it is value of a share, then 8,40,000 divided by 5,000 should have been the answer, 168. But if I look at the total value, yes, that is 8,40,000, option 1. What is the fair value of A's investment? That is 5% stake that I hold, that is going to be 42,000, option B. Second, this is on revenue barter. Third MCQ, A has a telecom segment. It entered into an agreement with B, which is engaged in generation and supply of power. The agreement provided that A will provide 1 lakh minutes of talk time to employees in exchange of getting power of 20,000 units. So remember, revenue is to be recognized at the consideration that you are likely to receive, and what you are receiving for giving the minutes is actually power, that is 20,000 units of power. A normally charges 0.5 per minute and B charges 2.5 per unit of power. So for A Limited, which is giving the telecom minutes, consideration that is received is 20,000 units of power at the rate of 2.5, and hence 50,000 will be the consideration received, and that should be my revenue. Point 3, what is the revenue to be measured by A in case of the telecom segment? That is based on the consideration received, that is 50,000. Third, this is regarding borrowing cost. MCQ 4, 5, 6 are pertaining to this. A began construction of a new building at an estimated cost of 7 lakhs on 1st April. To finance the construction, obtained a specific loan of 2 lakhs at the rate of 9%. So 2 lakhs into 9%, maybe 18,000 is the interest on the entire 12 months per annum. Then the other outstanding are 7 lakh and 9 lakhs. So there's a total 16 lakhs worth of borrowing, and the interest over here will be probably 8,40,000, and the interest over here will be probably 9,90,000. So if I total up 840 and 990 comes to around 84,000 and 99,000, bad maths. So this is 1,83,000. Okay. The expenditure incurred are, so you have expenditures incurred at various days. Construction was completed by 31st January. That means from 1st April to 31st January, basically the construction took only 10 months. We will assume the asset is qualifying unless otherwise given. The construction of the building was started on 1st April and all the expenditures had been incurred at the beginning of the respective month. So what is asked? What will be the capitalization rate for computation of borrowing cost for general borrowings? So the total borrowing cost is 1,83,000 for the entire 12 months, and your total borrowings are around 16 lakhs for entire 12 months. If you want, you can do each of this numerator and denominator for 10 months as well. Your answer will remain the same. So this is 1,83,000 upon 16 lakhs comes to 11.4375. Your answer is point C. What is the total borrowing cost on specific borrowings? So when I look at specific borrowings, maybe specific borrowings are worth 2 lakhs. And on this 2 lakhs, your interest rate is probably 9%. However, the asset gets ready for use in 10 months. So the borrowing cost to be capitalized will be for 10 by 12. And hence, this will come to around 15,000 if I have to find the borrowing cost to be capitalized. If that is the case, it is 15,000. What is the total amount of borrowing cost on general borrowings? Again, they have just mentioned total amount of borrowing cost, but well, quite literally, the total amount of borrowing cost on specific borrowings is 18, but the borrowing cost to be capitalized is 15. Similarly, the total borrowing cost on the general borrowing is 1,83,000, but the amount to be capitalized, that is what we have to calculate. So they have not worded it the best way, but nevertheless, with assuming that they had mentioned that this is the borrowing cost to be capitalized, because the answer is given that way. 1,50,000 is entirely out of specific, nothing out of general. 2 lakhs, may say 1,50,000 is done, 50,000 is still remaining. So over here, out of the 2 lakhs into 11.4375%. But this is in August, from 1st August to 31st January, I think this is 6 months into 6 by 12, again into 11.4375% into, let us say this is going to be for 4 months, and last May this same into 1 month. So if I do all of this, I think I will get 22,875. You can sit and calculate and you will get 22,875. Most likely this will be your answer. Okay, so this is the first case. Then you go to the second case, where you have again a very general paragraph, and then you have a question regarding biological assets, and then 2 questions regarding financial instruments. So let's quickly review this. D, for its dairy business, purchased cattle at an auction on 30th June 20x1. The purchase price was 1 lakh. Cost of transporting cattle back to the entity's farm, this is cost to transport it, is 1,000, and selling price on 31st March, end of the year, is 1,10,000. Company would have to incur similar transportation cost if it were to sell the cattle at the auction. So it will have to bring the cattle back from its farm to the auction place, where another 1,000 will be incurred. In addition to an auctioneer fee of 2% of the sale price, auctioneer charges 2% of the selling price from both the buyer as well as the seller. So initially, when you bought this, what must you have spent? Well, your entry would have been cattle account debit. This is your initial fair value to, let us say, bank. How much would we have spent, sir? We would have spent 1 lakh plus 1,000 to take the cattle to the farm, directly attributable. So that is you would have spent to bank, and 2% of 1 lakh, that is 2 rupees. So 103 you must have paid to the auctioneer. Now when you go to sell it, the fair value, let's say if I had to immediately sell it, the fair value is 100 minus the cost to transport the cattle back to the farm. So this is another one from the farm to the auctioneer's place, and 2 rupees you will have to again pay to the auctioneer, and hence 97. And hence there would be a loss on initial recognition that will be recorded at 6. Further, at the end of the year, this cattle is now worth 110, on which another 2.2, I believe, must be the auctioneer's fee, and 1 rupee to be incurred to take the cattle back. So this is 106.8. My ledger shows 97, and now it is becoming 106.8. So this increases by 106.8 minus 97. This increases by 9.8. Okay, so over here, when you look at the question over here says, what will be the gain on initial recognition, gain or loss of the biological asset? I said there will be a loss of 6,000. Achha, this is a gain, this is a loss. Okay, so this is point D, loss of 6,000. Second, what will be the gain or loss on 31st March 12? So there will be a gain of 9,800. 9,800, this is gain. Answer is point A. Okay, next you have irredeemable preference shares with a face value of rupees 10. Irredeemable, that is an equity feature for the principal, and a premium of 90. These shares carry dividend of 8%. However, dividend is paid only when D declares dividend on equity shares, which is discretionary. And hence, do I have an obligation to pay this 8%? No. And hence, this is also equity in nature. And hence, the entire instrument is equity over here. Borrowings from Z for 10 lakhs with settlement against issue of certain number of equity shares of D itself, whose value equals 10 lakhs. Achha. Fair value per share to be determined based on the total number of equity shares to be issued, to be determined based on the market price of D at a future date upon the settlement. So the number of shares are variable. 109 says if the settlement happens for a variable number of own equity instruments, it is a financial liability. Over here, the settlement is happening for a variable number of own equity instruments, and hence it's a financial liability, assuming D is an issuer of both of these instruments. So if I look at point 9, for irredeemable preference shares, the answer is equity, whereas for borrowings, the answer is a financial liability. If I was an holder of these instruments, it would be a financial asset in either of these cases. Okay, then you go to case study scenario number 3, again a very general paragraph, and then this is largely regarding joint operation and joint venture and associate. So let us review. H holds 12% of the voting shares of Z. Z's board comprises of 8 members and 2 of these members are appointed by H, casting a significant influence. They have clearly told you that these 2 members are casting a significant influence. Now, typically, how is significant influence defined? A significant influence is defined as a situation where an entity has an ability to significant influence, which is from participation of policy making process, operating financing policies. If you are participating, interchange of management personnel, board rights, etc., all give evidence of an influence. If nothing is there, we can take 20% as a barometer. But if the question specifically tells you that there are indications which exist, that you are 2 members sitting on the board which are significantly influencing, in which case you are considered to have significant influence. Each of these board members had 1 more vote in the meeting. So H is holding 12% plus having 2 members which are casting a significant influence. So H ke liye Z will be an associate. So when I look at MCQ number 11, what is the relationship of Z with H? Well, Z will be an associate because there is a significant influence relationship. Now, subpoint 2 is a little, I would say, debatable. There is a similar question that we have covered in business combination. For this, which is largely pertaining to control, over here, they have asked you H holds 10% of the voting power of G. The balance 90% voting power is held by 9 other investors, each again holding 10%. So, looking at the facts of the case, you are one of those 10 people. It is not you having 10 and the world at large maybe having hundreds and thousands of shares. No, there are exactly 10 people out of which you are holding 10. Others are also holding 10, 10, 10. So each of them seems to have, let us say, some say. The decisions about relevant activities except decisions upon borrowings of G are taken by members holding a majority of the voting power. So I cannot say that H has control, because with a 10% stake, I cannot have the ability to direct the relevant activities. There is no joint control as well, because there is no contractual arrangement between the parties whereby they are deciding to vote together, and hence there is definitely no control, there is definitely no joint control. The decisions about borrowings are required to be taken by unanimous consent. Decisions about borrowings are not the decisions which most significantly affect the relevant activities or returns. So what do you guys think? Now there are 2 possibilities over here. For sure there is no subsidiary, there is no joint venture. However, can 10% give you significant influence? By default, no, and hence the standard answer could have been that, well, it is just an investment, not an associate, not a subsidiary, not a joint venture. However, one can say that 10% in light of the fact that there are 9 other investors holding 10% each, maybe my 10% gives me significant influence, other people's 10% also gives them significant influence. So in my opinion, that is why I have circled this. There are 2 possible alternatives. There can be point B, or I would have answered point D looking at the facts of the case, but again it is subjective. ICAI has taken point B. We will also take the same, probably because of this sentence, that the balance is also held by 9 other investors, each holding 10%. If it was given that the balance is held by someone holding 90% stake, I would have said my 10% does not give me any influence, let alone significant influence. And hence I would say that that does not seem to be associate relationship, but because everyone is holding 10%, probably this can be said to be a significant influence case, though an alternative treatment is possible. If a question like this comes, probably institute should ideally consider both. Having said that, institute in this case has taken B as your answer. What is the next case? H is engaged in the business of pharmaceuticals. It has invested in share capital and is holding 15% of the voting power. So if the question ends over here, 15% does not give me any significant influence. However, Y is engaged in the business of producing and packing materials for pharmaceutical entities. One of the incentives for H to invest in Y was the fact that Y is engaged in the business of producing packing materials, which is also useful for H. Since the last many years, almost 90% of the output of Y is procured by H, and hence there is an operating relationship between these entities, and hence clubbed with the 15% stake and having participation in operating, we can say that there exists a significant influence, and hence your answer, rightly so, is option B, where Y is an associate of H. Okay, so this is regarding 12, 13. Now you go to 14 and 15, which are more theory. 14 is based on conceptual framework, whereas 15 is based on technology. We'll quickly review this. With respect to the best practices applicable to all companies, which of the following is incorrect? Comply with the standards and regulations, but also ensure that financial statements are an effective part of a wider communication. Yes, this is correct. Disclose complete information in the financials to avoid further cross questioning. Again, this is correct. Reduce generic disclosures and focus on company specific disclosures and explain how the company applies its policies. Also correct. So by the law of elimination, answer should be point D. Do not disclose assumptions and bases so that users are not misled. No, you have to disclose bases or assumptions like FIFO, for example, that you are using, that is a base for measuring inventory, or assumptions like actuarial assumptions that you are using, and hence do not disclose. No, that is wrong. We will have to disclose. This is the incorrect answer. D. Which of the following proactive measures do not mitigate cyber security risk? They do not mitigate. Ensure that all passwords are simple and not change regularly. No, you have to change them regularly. So your answer should be A. Other things like include procedures for detecting and mitigating impact of cyber security. Yes, that is mitigating security, cyber threat. Ensure firewalls are used. Again, that will mitigate cyber threat. Ensure data backups are done. Again, that will mitigate cyber threats, and hence your option over here is A. Now, when you look at the descriptive questions over here, you see a reverse acquisition type of a question which is there, and almost every other question you would have done somewhere or the other, except for 5B, which is a slightly different question. So I would want you to review this. This is not exactly similar, but in a way, type of the November 23 exam question on leases which had come. So I would definitely want you to refer 116 के लिए ये जो question है. It's a fairly detailed question. If you want, you can pause and read it once. Otherwise, we will read it together and just discuss what is to be done for this particular case. So let us review this. Feel Fresh Limited. The company is into manufacturing and retailing of FMCG products. So over here, FMCG products like soaps, for example, and is listed on the stock exchange. One of its products is bathing soap, which the company sells under the brand name of Feel Fresh. So basically, there's a company like Hindustan Unilever who's selling a soap. The company does not have its own manufacturing facilities for soap and therefore enters into an agreement with third parties to procure the soap. So you are a brand and there are job workers or companies who will manufacture the soap for you based on your standards, your requirements. The company has entered into a long-term purchase contract of 10 years with Messrs. Radhe. Following are the relevant terms of the contract with Messrs. Radhe. So these are the terms given. Now Messrs. Radhe has to purchase a machine costing 10 lakh rupees. Who is purchasing? Messrs. Radhe. We are not purchasing, so we are not the owner. Messrs. Radhe has to purchase a machine costing 10 lakhs from the supplier as specified by the company. The machine will be customized to produce soaps as designed by the company. So there will be some customization. The machine cannot be used by Messrs. Radhe to produce soaps for buyer other than the company due to the design specifications. The machine has a useful life of 10 years and straight line method of depreciation is best suited considering the use of the machine. So over here, can I say that this machine is an identified asset? Sir, when is it an identified asset? When it is physically distinct. Well, this machine is explicitly identified in the arrangement. It is physically distinct and the supplier does not have a substantive substitution right. The supplier, that is Messrs. Radhe, cannot substitute this for anything else and you cannot even use this for any other buyer. Second, for you to say that there is a hidden lease, the company should get a right to direct use. When do you get a right to direct use? When substantially all benefits from this machine flow to you. Well, we can see over here that we are entering into a 10-year arrangement with this company and the life of the machine is also 10 years. Supplier, that is Messrs. Radhe, cannot use this machine for any other purpose and as a result, we can say that we are getting substantially all benefits from the use of the asset and let us say there should be a right to direct use. That is the decisions on for how and for what purpose the asset will be used can be directed by us. Okay, so we can direct how is to be customized. So there seems to be a lease because over here there's an identified asset and on that there is a right to control use that company has. So the company has a right to control use and hence there is a lease. So they have given you a fairly detailed explanation on why there is a lease. Okay, this is point 1. Point 2, the company will pay 4.75 per soap for the first year of the contract. This is calculated based on the budgeted annual purchase of 7 lakh soaps as follows. So we have figured out that we will buy 7 lakh soaps and for which we are going to pay 4.75. Okay, but how much of it is paid for the machine and how much of it is paid for job work? So when you look at lease, you will say that okay, if there is a hidden lease, you will create an ROU asset. You meaning a company, not Messrs. Radhe. The company, Radhe is owning the machine. Company will create an ROU asset with a corresponding lease liability, which is calculated as the present value of the lease payments for the lease term. So when I look at the lease payments include the fixed lease payments, which includes lease payments which are in substance fixed, but it will not include variable lease payments unless they are linked to a rate or an index. So over here for 7 lakh soaps, the annual budgeted production is, there is a variable cost of manufacturing of 4. This Radhe will incur, which we are compensating. Cost of the machine, for the cost of the machine we are going to pay 1,74,015 divided by 7 lakh soaps. So that comes to maybe an absorption amount of 0.25 per unit. And then Messrs. Radhe's margin, this will be for the work that Radhe is doing as a job worker to manufacture the soap. This is 0.5 in total 4.75. So can I say 4.75 is paid only for the machine? No, a part of it is paid for the work that Radhe is doing for making the soap. A part of it is paid for the machine. Now how much seems to be paid for the machine? Well, 0.25 seems to be paid for the machine. But this is again variable. Remember, variable lease payments will not be taken unless they are linked to a rate or an index. In case a company purchases more than 7 lakh, that is the budgeted number of soaps in the first year, then the cost of the machine, that is 0.25 per soap, will not be paid for the soaps procured in excess of 7 lakh units. So basically you will have to pay only 7 lakh into 0.25, that is equal to 7 lakhs into 0.25 comes to, I think, approximately 1,75,000 या फिर 1,74,015, whatever it is. However, in case the company procures less than the budgeted soaps, maybe 6 lakhs, then the company will pay the differential unabsorbed cost of the machine at the end of the year. For example, if the company purchases only 6 lakhs soaps in the first year, then 6 lakhs into 4.75 तो pay कर ही लोगे, तो out of that 6 lakhs into 0.25 you have paid. Then the differential amount, what is the differential amount for the 1 lakh units that you short purchase into 0.25 approximately of around 25,000, that is a differential amount of 24,015, that is 174 minus 6 lakhs into 0.25 will be paid by the company to Messrs. Radhe at the end of the year. Which means, can I say this 174,015, कैसे तो वो calculate हुआ, they will explain later, but this 174,015 which is agreed to be paid for the machine is in substance fixed. You buy more than 7 lakh soaps, you still have to pay 174,015. You buy 0 soaps, you still have to pay 174,015. The remaining 4 and 0.5 you will not pay, but 174,015 you will have to pay, so that is in substance fixed. Okay, variable cost will be actualized at the end of the year. So you will pay only the actual variable cost. So this is clearly variable. This is in substance fixed. Even this will be taken as variable. The cost of the soap will be calculated for each year in advance based on the budgeted number of soaps to be produced each year. The amount of 174,015. So this is a mystery here. 174 आया कहाँ से? Shall be considered for each year as the cost of the machine from years 1 to year 8 while calculating the cost per soap. So for each year we are clear कि भाई variable cost change हो सकता है, but 174,015 will be the cost that I will recover in each of the first 8 years. Any differential absorbed amount shall be paid by the company to Messrs. Radhe at the end of that year. Okay, a charge of 174,015 for the machine is derived by using the borrowing cost at the rate of 8%. Abhi, what is this? Maybe this is like your EMI or EI. You are saying that if I take 174,015 into the PVAF just for my reference at the rate of 8% for a period of 8 years, this will be what? 1 divided by 1.1 divided by 1.08, 1, 2, 3, 4, 5, 6, 7, 8. If I do a grand total, this is 5.7466. So 174,015 into 5.7466 comes to approximately, I can say 10 lakhs. So what they must have done is, I am buying 10 lakh worth of machine. Radhe would have said, I am buying 10 lakh machine for you. The borrowing rate or time value rate is 8%. You need to compensate me for the machine, so I will charge you 174,015 in each of the 8 years so that I can recover the cost of the machine which is exclusively used for you. For years 9 and 10, only the variable cost and margins will be paid. So the agreement is for 10 years. In the 9th and the 10th year, you are not paying anything for the machine. Machine will run. You are going to pay for the first 8 years for the machine. Okay. Messrs. Radhe does not have the right to terminate the contract, but the company has a right to terminate the contract at the end of each year. However, the company terminates the contract, it has to compensate Messrs. Radhe for any unabsorbed cost of the machine. So there is a significant termination penalty involved. So if you terminate, there is a significant termination penalty. For example, if the company terminates the contract at the end of the second year, it has to pay 10,44,990 Why? Because 174,015 you have paid only for the first year. For the remaining 7 years you are yet to pay, or 6 years you are yet to pay. So this you will have to pay. If it terminates the contract after the 8th year, that the company does not have to pay compensation since the cost of the machine would have been absorbed. But we can say over here that there is a significant termination penalty involved, and hence the termination is unlikely to happen. In any case, it appears that since you are not into the business of manufacturing soaps yourself, you are just going to sell this, a long-term purchase contract of 10 years, we can say that the lease term is, for example, 10 years over here. In the first year, the company purchases 5,50,000 soaps at 4.75 per soap. Analyze the contract of the company with Messrs. Radhe and provide necessary accounting entries for the first year in accordance with Ind AS with working notes. Assume all cash flows occur at the end of each year. So this is a little complicated, I would say. So when we have to, let's say, do this working, we will first figure out that if there is a hidden lease. Yes, there is. So is whatever the payment you are making 4.75 per unit attributable to the lease? No, you will have to allocate some payment to the lease and some payment to the non-lease component. So we will say that out of the total payment, we can say 174,015 with confidence we can say is attributable, for example, towards the lease component, and as a result, when we go to see in this particular case, if I want to find the lease liability and the ROU asset, that is calculated as the present value of the future lease payments, you will take the PVAF at the rate of 8% for 8 years. After that, nothing is being paid, and here total 10 lakhs aayega. So if I had to pass a journal entry at year 0, my journal entry will be in the books of the company ROU asset. You will create an ROU asset for 10 lakhs to lease liability. Let us say 10 lakh rupees. So this will be your first entry. Now what will happen to the ROU asset? Well, ROU asset will be depreciated. You are intending to get the right of use over 10 years. You might be making the payment over 8 years or whatever, but you are going to get the benefit, let us say, over 10 years. In which case, let us say if I were to depreciate, your entry will be depreciation account debit, which goes to the P&L of 10 lakhs. You have been given that we will take the straight line depreciation to the ROU asset in the books of the company. This is going to be 1 lakh. So this is taking care of the ROU asset. When I look at the lease liability, for the lease liability, there would be a finance cost. So finance cost account debit, this is 10 lakhs into whatever is the rate. I believe the rate was, I think, 8%, and hence 80,000 will be finance cost, let us say, to lease liability. And how much are we paying? Well, we are going to pay in year 1, we are ultimately going to pay at the end of the day 5,50,000 soaps have been purchased. For that, I will pay 4 for variable cost, 0.5 as a margin, irrespective, considering absorbed, unabsorbed, you will have to pay 174. So we will say lease liability account debit 174,015 to bank, you will pay. Apart from that, for the other variable cost, so this is cost of job work for, let us say, soap, cost of job work for soap, this will be taken to your P&L. This is not for a right of use, this is a non-lease component. This is 4 rupees plus 0.5 into actual number of soaps purchased. This is 5,50,000. So this is 5,50,000 into probably 4.5 comes to around 24,75,000. This is 24,75,000 to bank if it is paid, to, let us say, payable if it is yet to be paid. But this cannot be a part of your lease liability because it is paid for the cost of manufacturing of the soap. So if we try to probably look at the solution for this, Let me just verify if we have this handy. Yes, RU asset to lease liability 10 lakhs, then interest expense 80,000. Depreciation will be based on the 10-year life. We may be making the payment for 8 years and then not making any further payment at least for the last 2 years, but we are getting the benefit on the asset for the entire 10 years. Lease liability to bank will be 174 and then cost of the soap 2475 to bank or Messrs. Radhe if it is not yet paid. And this takes care of question 5B, which is a slightly tricky question. It is maybe based on the lines of a question which came in the November 23 exams. But this is something that you should definitely refer. Other questions in this MTP I think are quite manageable. So this takes care of the series 1 MTP. You will go to series 2 MTP. I don't think there is anything very significantly different over here, but nevertheless we will quickly refer the MCQ cases, and there is one small question at the end of Ind AS 37 which we would want to discuss. So let's get done with this. Over here again a general paragraph. ABC manufactures automobile parts. It has a net profit of 20 lakhs for the third quarter. Following adjustments are made for computing the net profit. This is for Ind AS 34 interim financial reporting. Bad debts of 1 lakh were incurred during the quarter. 50% of the bad debts have been deferred to the next quarter. Why? If they are incurred in the current quarter, from this 20 lakhs, you will subtract the 50,000 that you were wrongly deferring into the next quarter. 5 lakhs expenditure on account of admin expenses pertaining to the third quarter is deferred on the argument that the fourth quarter has more sales and hence should bear. That is wrong. Expenses are recorded as and when they are incurred, and hence the adjusted profit of this quarter should be 14 lakh 50. Okay, based on that you have two MCQs. What will be the treatment of bad debts during the third quarter? First, bad debt expenses incurred during the third quarter should be recognized in the same quarter. That is correct, and hence 50,000 should be deducted from 20 lakhs. Well, 1 lakh should be deducted, but out of which 50%, that is 50,000, would have already been deducted, and hence the remaining 50,000 should be deducted. Your answer is option A. Second, the correct net profit to be shown in the interim report of the third quarter, well, this will be 14 lakh 50. That is option D. Okay, next you have ABC enters into contract to build a power plant for a customer. This is regarding performance obligations. The entity will be responsible for overall management of the project, including services to be provided like engineering, site clearance, foundation, etc. All of these different promises are a part of a significant integration activity, and as a result, they are to be treated as a single performance obligation. Third MCQ, how many performance obligations do we have? Well, a single performance obligation. Option C, because they are a part of a significant integration activities, and these promises, though they might appear to be very different, they are a part of a single integration exercise, and hence they are not distinct, and hence they are a single promise, single performance obligation. In the financial year 11-12, ABC incurred the following expenditure on acquiring property consisting of 6 identical houses, very similar to a sum that we have done for Ind AS 40, with separate legal title and the land on which it is built. So 6 houses, there is separate legal title in the land. So expenditures on 1st April, purchase cost is 1 crore 80, non-refundable transfer taxes of 20 lakhs should be added. So 1 crore 80 and 20, that comes to 2 crores. On 2nd April, legal costs relating to property acquisition 5 lakhs will also be added. So 2.05 crores will be the overall cost for all the 6 properties. On 6th April, advertisement expense for the tenant, this will go to the PNL. 8th April, opening ceremony, inauguration expenses will go to the PNL. Throughout 2002-03, incurred 1 lakh towards day-to-day repair and maintenance. This will subsequent expenditure goes to the PNL. Now ABC uses one of the 6 houses for office, so this is PPE, and accommodation of its staff, and other 5 houses are rented to independent parties. So this is investment property. So basically 2.05 crores is a total cost, out of which 1/6 will go towards PP and 5/6 will go towards investment property. So maybe around 170 point something, and then maybe around 24 point something will be going towards PP. So if you look at this, cost of the entire property will be 2 crore 5. Cost of the investment property, this is 5/6, that is around 1 crore 70, not 74, 1 crore 70 and something. And the cost of owner occupied property is close to, I think, 34, not 24. This is 34, sorry, 34 and something. Okay, so this is just total cost into 1/6 and 5/6 will proportionately allocate. Okay, second case scenario, again a general paragraph, and then you have a question pertaining to EPS. Profit attributable to ordinary shareholders of the parent entity is 12 lakhs. Weighted average number of ordinary shares is 5 lakhs. So if I do 12 lakh divided by 5 lakhs, my basic EPS should be 2.4. Average market price of one ordinary share is 20. Weighted average number of shares under options is 1 lakh, and exercise price of the share is 15. So you'll have to find the incremental shares or the free shares, which will be, for example, you will say that I will issue 100,000 or 1 lakh minus 100 into 15 divided by 20. So if I do this, 100 into 15 divided by 20 comes to 75. So 100 minus 75. So this is 25,000 incremental shares. So if I want to calculate the diluted EPS, I will still have 12 lakhs in the numerator, and in the denominator 5 plus 0.25, that is 5.25. So this is 12 divided by 5.25 comes to around 2.29. So over here, this is based on the facts. What is the basic EPS? I would say basic EPS is 2.4. What is the diluted EPS? Second sub point, this is 2.29. Okay, this is very easy. Then you have sub point 2, DEF enters into contract to buy 100 tons of cocoa beans at 1000 per ton for delivery in 10 months. Okay, so this is having a commodity, that is cocoa beans. On settlement, the market price of cocoa beans is 1500. So there is a difference of 1000 and 1500, that is 500. But the contract cannot be settled net in cash and is entered for delivery of cocoa beans in line with DEF's expected purchase or usage requirements. And as a result, I cannot say that this is a derivative. There is a commodity contract and this is not going to be net settled, and hence it is not going to be a derivative under 109. You will get the own use exemption and you will account it as per the respective standards. Let us say Ind AS 2, as and when you are purchasing, it is basically an executory contract that when I sign the paper, neither of the parties have performed their share of the agreement. No, neither have I paid money, nor have they given me beans. So this such contract is called as an executory contract, and it is not treated as a derivative for the purpose of Ind AS 109. So over here, this is something that you can refer. What is the nature of contract for cocoa beans? We will say point D, executory. That is, none of the parties in the contract have done their part of the contract, and it is a non-derivative contract because 109 will not apply on this. Point D. Then you have point 10, again linked to 109. DEF invests in compulsory convertible preference shares issued by its subsidiary B at 1000, face value 10, premium 990 under the terms of the instrument. Each CCPS is compulsorily convertible into one equity share of B at the end of 5 years. Such CCPS carry a dividend of 12% per annum payable only when declared at the discretion of B. So over here, CCPS, if I go to CCPS, what is the nature of the financial instrument in point 3? Now this is a little tricky. They should ask you financial instrument from whose perspective? From A's perspective, it is a financial asset, but from B, that is the issuer's perspective, it is an equity item. Why? Because the settlement is happening for fixed number of entities on equity instruments, that is one, and there is no obligation to deliver cash because 12% is actually discretionary. Hence your answer comes to be C, if there is equity, if it is from the perspective of B. So it's not as well worded. If it comes in your main exams, hopefully it should be a little better worded. From the perspective of DEF, it is an investment, a financial asset, but from the perspective of B, it is an equity item. Okay, the third case, PQR is required to adopt Ind AS from 1st April 20x1. This is the date when you are adopting Ind AS with comparatives for 1 year, that is 20x0, 20x1. So you have to give, as per Ind AS 101, the first Ind AS financial statements may be the year 1-2. However, you have to give 2000 and 2001 as a comparative. And hence your transition date, if they ask you, will be 1st April 20x0. On 1st April 20x1, PQR acquired 30% of the voting shares of X for 8,000. So that gives me significant influence. Ind AS 28 might apply. PQR accounts for the investment using the equity method as prescribed under Ind AS 28, which is correct. At 31st March 20x2, it recognizes each share of net asset changes using the equity method as follows. So from 8,000 where it started to this, plus its share in the profit, plus its share of exchange differences in OCI, this is FCTR, a part of reclassifiable OCI, plus its share of revaluation, non-reclassifiable OCI. So total, by the end of the year, my investment should appear at 8850. 700 would have gone in my consolidated PNL, 100 in my consolidated FCTR, 50 in my consolidated revaluation. The carrying amount of the investment in the associate was 8850. Perfect. On 1st April 20x2, the very next day, PQR acquired the remaining 70%, which means that gives me control. This is my date of acquisition of XYZ for a cash consideration of 25,000. So what will be your PC? Where PC will refer to 70%, that is 25,000. However, for the remaining 30% also you are holding, so you have to remeasure this at fair value. and that will be a part of your PC. Fair value of the 30% interest already owned is 9,000. However, in your ledger you are showing at 8850. So there is a 150 rupees gain on remeasurement, which will be taken to the profit and loss account unless otherwise given. And the fair value of XYZ's net assets is 30,000. Fair enough. So I would say that my total PC will be 25 plus 9. Sir, 8850 was there? No, you would have remeasured it as per 103. You will remeasure the existing investment to fair value, and hence this will come to, let us say, 34,000. Okay. So what is the question asking? What is the fair value of the total consideration transferred by PQR to XYZ to 25,000 for 70% stake, and for the remaining 30% stake the fair value is 9,000, and hence a total of 34,000. Your option will be A. What is the amount of goodwill in the said business combination? There is 0 NCI, and hence PC, that is 34, minus net assets, that is 34,000, will be the goodwill amount, that is B. What is the gain on previously held interest in XYZ to be recognized in P&L? Now this is where you can possibly make a mistake. You can say that okay, we will recognize a gain on remeasurement, that is 9,000 minus 8850, which is perfect, which is 150. This will go to the P&L. But apart from that, what will happen to these OCI items? Remember, your FCTR is a part of a reclassifiable OCI, and hence on the happening of certain events, the balance in the FCTR will be transferred to the P&L. Now this FCTR was arising on the investment. Now this investment is derecognized. When you are acquiring the remaining 70% stake, you will take over assets and liabilities, then you will derecognize the investment. So if the investment is derecognized, the FCTR pertaining to that will also be derecognized. So you will debit the FCTR because it is reclassifiable, credit the profit and loss account, and hence 150 plus another 100, that is equal to 250, will go to the P&L. No sir, what about revaluation? Well, revaluation will be transferred directly to retained earnings. The question is asking me that how much will be recognized in the P&L? Well, for revaluation, my entry will be consolidated. Revaluation reserve account debit 50 to the retained earnings. Let us say 50, and hence your answer is 250. By natural instinct would have told me 150. However, what goes to the P&L ultimately is 150 as gain on remeasurement, as well as 100 as the gain due to the transfer of the FCTR. What is the transition date? We said this was 1st April 20x0, a year before, so the first day of the comparative period. And PQR presents its comparative financial statements for the year. Well, that they will prepare the statements if the current year is 2001, 2002. Then the comparative will be 2000 to 2001, and hence this will be, let us say, your comparative statement. Now, by and large, this MTP does not have new questions per se. One question that I want you to refer is the last question. What is this? 6C. This is similar to an example in the institute study material. However, it is not as logically coming to you. So when you read it, you will feel a particular answer, but probably there's a different possibility here. So let us review this. This is for Ind AS 37. Under a new legislation, an entity is required to fit smoke filters to its factories by 30th September 20x1. So the new law says that you will have to fit filters by 30th September 20x1. Okay? The entity has not fitted the smoke filters. Okay, it is assumed that a reliable estimate can be made of any outflows estimated. Determine whether any provision is required to be made by the entity on 31st March 20x1. See, here the answer is very clear. You are required to fit the smoke filters by 30th September 20x1, and hence if you have not fit the filters by 31st March 20x1, you still have 6 months, and hence there is no need to create any provision because there is no present obligation as of now. The problem is, as on 31st March 20x2, that is, if by 31st March 20x2 you have not fit the smoke filters, then should you create a provision? Now, by default, most of the students would say yes, because over here you had to fit the smoke filters by 30th September, you did not fit them, and hence you will have to create a provision. Now the thing is, it is something like this. How the institute has answered, it is like saying that, let us say the government makes it mandatory in cars for everyone to wear a seat belt, even for people who are sitting behind. Now you decide that you don't want to wear seat belts. It is strongly advised that you should, but let us say you decide you don't want to wear seat belts, and even after 30th September you are operating without wearing seat belts. Does that mean you have to create a provision? No, but over here the law says that you have to wear seat belts in a similar way. The law says you have to put on smoke filters. Now if you get caught, they will charge you a penalty. So if a camera catches you, violating, you will be levied a penalty, in which case you should create a provision for penalty, but not a provision for creating a smoke filter. That is what the institute wants to say. So over here, can the government force you to put a smoke filter? Well, the government can extract penalty from you. So you will have to refer the legislation and see if there are any penal provisions, if they are, and if that creates an obligation for penalty, you create a provision for penalty, but not a provision to put the smoke filter as per the institute solution. So if this comes, and this is there in the institute example, one of the examples as well, even the same solution is given, which is in a way debatable, but kind of in certain circumstances you will have to see the facts of the case and accordingly answer. But from an exam perspective, you can say that in such cases the government cannot force you to fix a smoke filter, and hence on 1st, 2nd, 3rd October there is no provision to be created necessarily for the smoke filter if you don't want to fit it. However, if there's a penal provision which is there, then you will have to look at the law, and once you get caught and if you have levied a penalty, you will have to create a provision for the penalty. So that is regarding this particular question. So this by and large takes care of these questions. I hope you have got a fairly good understanding of these MCQs as well as the questions. So please do let me know if this video was helpful. If yes, please do press the like button, and keep studying hard. Good luck, and I'll see you soon with more such videos. Keep working and wish you all the very best for your preparations. Goodbye, good luck, and take care.